Hi, everyone. Joe Kehrig, managing broker of Coldwell Banker Real Estate in Danville, and this is your San Ramon Valley real estate update for the week of August 3rd. Now, in years past, the last 6 or 7 years, August was really the slowest month of the year because people were getting ready for school, they were getting their last vacations in, before the school year started. But as we know right now, all of that's up in the air, as far as how the kids are going to go to the school. And from a real estate type standpoint, it's completely different also because as I've mentioned in weeks past, February was the best February we had in 13 years. Then obviously COVID-19 hit in March. All the real estate market did was pause because when we started coming back, like June, that was really our March 1st in the real estate business. So we're in the middle of our spring. We're in the middle of, I've been doing this for 42 years, and I will tell you, I've never been busier. I mean, the teams, the agents I manage have never been busier. There's just so much business, and there's still, as we'll see, and as we've talked about, a lack of inventory, which puts forward its own challenges, for buyers out there. But when's it going to end? I don't know because what normally would slow down the market when we hit our normal February, March, April, the busiest times of the year. Matter of fact, I would say 95% of the appreciation that's happened over the past years happens during those 3 months because not a lot of people put their home on the market during the winter. The buyers come out in February. There's not a lot of inventory, and because of supply and demand, that's what jack prices up. You have three buyers for every one home. Then what would normally happen is after Easter, spring break, a lot of agents wouldn't put homes on the market for a couple of weeks because they didn't want to put them on where half the people were gone. 1 week parochial schools were off, the next week, public schools were off. So all of a sudden we'd have 3 weeks of inventory come in after the Easter spring break, and we'd still have more buyers, but instead of three buyers for every one home, we'd have four buyers for every four homes. And what would happen is during the summer it would kind of level things off, but it would all just be because we have more inventory hit during the summer. So what it would do is it would pump up the supply, which would even the market out a little bit. Now we're in a situation where we're basically in our spring market. So, and when we hit October, November, which, if we count that as going into our summer season, we're not going to see a lot more homes hit the market because, a lot of people don't put their homes on the market during the holidays. Matter of fact, there's such a lack of homes out there for many, many reasons. The fact that, the population is growing, interest rates are low, more people can afford homes. And where, the latest Wall Street Journal report, where we used to figure people stayed in their homes 7 years, the latest is 13 years. So people just aren't moving because, property taxes and their grandfathered in maybe on their interest deduction. But there's a lot of reasons why people aren't moving. So it creates a lack of inventory out there. So I don't think for this market to settle down, it's not going to be because we see a lot more homes hit the market. The supply is not going to go up because, again, when we would normally see that supply go up is at the beginning of summer. And if we count this as being our spring, that's like November, December. And there's a couple reasons that we're not going to see inventory come up. People don't put their homes on the market, as I mentioned before, during the holidays. Plus, it's an election year. And here's what buyers and sellers don't like. They don't like uncertainty. And they're going to wait to see what happens. So for this market to even out a little bit, you're going to have to see, not necessarily more inventory, because I think the inventory is always stay low. You're going to have to see less demand. Well, how do we see less demand? Interest rates go up, and homes become less affordable. No one's anticipating interest rates to go up because overall the economy is still struggling, because of the COVID-19. So no one's expecting interest rates to go up. And so I think the demand is going to stay high. Now, we might see a peeling back of buyers' interest, as we get to the election and the uncertainty that I talked about. But that's about the only thing. So I don't really see an end in sight. It's definitely not from a standpoint of more inventory hitting the market. So let's take a look this week. Let's look at the San Ramon market. You can see again, inventory is going down 113 to 112 to 98 active homes. Now, you look at it and you can see the pending sales because the one thing we talked about is when you see that there's more pendings than actives, it's absolutely a seller's market. Normally, you're used to seeing, and when we just started getting back after COVID-19 in June, the pendings were way below the actives, but we've seen week after week after week that invert, which basically is a seller's market. And you look at it and you sit there and go, well, pending sales went from 144 to 135. Well, no, when you look at the closings and there were 27 closings, that means there was a net 19 home sell in San Ramon, and you can see that the inventory wasn't keeping up with it. So you see that curve going down. So definitely that market is getting tougher as far as leaning more and more towards a seller's market, and you'll see that when you look at the average price sold. Danville, the same type of thing. You see that the pending sales have stayed pretty consistent, from 135 to 134, how many pendings there are. But when you add in the 22 closed sales, that means there were 21 properties go pending in Danville. And you can see the inventory is staying pretty steady, which is good. I mean, it's still a seller's market, but at least you're not seeing the inventory drop too much, because 2 weeks ago you saw it really drop. So again, still very much a seller's market. Now, naturally, you're going to ask, hey, should I be a buyer in this market? I would be a smart buyer. I would be a smart buyer because, there's still inventory out there, and you might have to pay 10, 20, 30,000 more than asking price. But at 3% interest rates, comparatively to just where we were a year ago at 4% interest rates, you're still buying the home cheaper, even if you pay $20,000 or $30,000 more. Plus, like I mentioned before, I don't really see an end in sight. You go all through the United States, and wherever there's jobs, the job market is good, the market stays strong. And certainly in the Bay Area, we've got a great job market. Here's the other thing in the San Ramon Valley that we're basically seeing. All the buyers are coming from the peninsula, because literally my son had a buyer that was renting a home in San Francisco, and now they're able to buy $1 million to $1.5 million home, which they couldn't buy in San Francisco, here, and they're telecommuting. So do you want to be cramped up in a condo renting in San Francisco, or do you want to be in $1.5 million home in Danville for the same outlay with the tax savings and such forth? So again, we're seeing a flood of people come out to from the urban to suburban. So that has a lot to do with it. Now you look at Blackhawk, and the Blackhawk market's staying steady. Now you see the pending sales have obviously dwindled down a little bit, but in the active properties have stayed pretty consistent, which is good. This is a good, solid market. When you think about it, you have 15 pendings and 23 sales. What that basically tells you is, man, there's a shortage supply of homes on the market. So I would even count this as being a buyer's market, but obviously because of the average price being over $2 million, matter of fact, what happened is everything on the lower end is getting burnt off in Blackhawk. The average sold price of the properties that just closed was $1.5 million. So all the low stuff got absorbed. And now the pending price is $2 million. But the active average is like 2.7 million. So again, real estate's like a pyramid. The higher you go, the less buyers you have. So this is a very, very active market, 2 million and below. But the reason you see the actives up there is because there's a lot of homes that are above $2.5, $3, $4 million that obviously take a lot longer to sell because of the supply and demand. There's just not that many buyers out there that can afford a $2.5 to $4 million home. Alamo has averages around $2 million, and you can see the pending sales are up 4 more. Plus, when you sit there and have 5 closed, that means you had 9 pendings in Alamo. Now, when you're talking about an average price of $2 million, that's a lot. The good part about it is you're seeing the active properties still staying pretty consistent. So this is a strong market, but again, you're not as inverted because of the price range. You're talking about an average price of $2 million compared to San Ramon, Danville, where you have $1 million. And then you go to Dublin, which basically is just under $1 million average. And you can see this market is just going nuts. You look at the pending sales, and then you look at the actives going down and down. So there's no end in sight in there because, again, we talk about a pyramid. As you go down in price, there's more buyers out there for you. So when we look at the statistics, well, as you would think, in the higher end markets like Blackhawk and Alamo, things are still selling for 98, 99% of asking. But you look at San Ramon, Danville, and Dublin, and for the most part, 100 to 101% of asking. So again, there's always some homes that will negotiate, but for the most part, things are selling at asking or above asking. Now I want to give you a website to have a little bit of fun. And this is a website that I heard about, and it's so interesting. So what it is, it's called How Money Walks. So look up How Money Walks, and you can do a map of any state and any county in the United States. And what it shows you are people moving out or people moving in. So the red can basically it tells you right now that in California lost 73.52 billion in annual AGI, adjusted gross income, from people moving out of the state. And when you do this live and you're on the website, that number just keeps growing and growing and growing. It's real time, and you can see where we get our wealth from. People moved here from New York, Illinois, New Jersey, Massachusetts, Connecticut, from the East Coast. But where did we lose the wealth to? Well, there's going to be no surprise here: Nevada, Texas, Arizona, Oregon, and Washington. The only other thing I can tell you from a Contra Costa type standpoint, Idaho is huge. Boise, Eagle, Meridian. People are leaving California in groves. Mainly for a lot of reasons: the tax base, the quality of life, because obviously when I say quality of life, we have a great quality of life here, but until you get on the freeways and have to go someplace. But now look at the next chart. Look at Contra Costa, how Contra Costa now is growing. It's actually picked up over $2 billion in adjusted gross income. And where are people coming from? Alameda County, San Francisco, San Mateo, Santa Clara, Los Angeles. This is people coming out of the city going into the suburbs. So Contra Costa is doing great. Contra Costa is building. But where are people going to from Contra Costa? Solano County, Washoe, Placer, Sacramento, Mariposa. They're basically, going to, in some cases, out of state, but in California, just, maybe moving more into the rural areas. But so anyway, it's a fun website to play with. Remember, How Money Walks. You can go to any county in the United States and see where are you losing, are you gaining, and where are people coming into that county and where are people going out from that county. And you can do it for each state. Very, very interesting. Obviously, you see states like Idaho and Texas and Nevada, and you see it's just pure green because everyone's moving into there for a number of reasons. But again, like we say, every market's local. Every neighborhood is individual, and even homes within the neighborhood. So if you have any questions about your individual home at all, again, please feel free to reach out to joe.kehrig at cbrealty.com. Cell number 925-487-6838. Have a great week, and may God bless you and your family, and may God bless the United States of America.